All right, everyone, welcome to another episode of Pitch Deck Insights, the real estate edition. I'm Litan, your host, and I'm here with my good friends Hans and Mike. All of us are really experienced LPs, but Hans is probably leading the way with about 100 plus LP positions. Our objective is to help LPs learn how to better review pitch decks from GPs in the private equity real estate space. We're giving objective insights. We're not pitching a deal. We have nothing to gain from this. We just want to teach LPs how to make better decisions investing. So without further ado, let's dive into the pitch deck. All right. So we have a pitch deck here submitted by Bloom Wealth Partners and HCG. Let's dive into it. Hans, anything you want to say for these initial slides? Any input on this stuff?
Not really until we get to the bios.
All right.
I think that's, to me, is kind of the first relevant slide here. And so there are two bios. There's this bio slide and then the next one. And if you notice, there's two different groups. So the first thing I'd want to understand is what are the relationship between the groups. Obviously, one of them is probably a money raiser, the second one. But overall, the bios, in my opinion, are way too brief. If you just read the bios and based on the verbiage, the assumption really from my perspective is there's not much multifamily experience as a group here. And one of the founders of Bloom is also a CEO of another real estate investment firm called Real Acquisitions in his more detailed bio. So quite honestly, if you right here, it's mentioned there, Scott is also CEO of Real Acquisitions. So it's really confusing to me, the relationship with the groups and exactly what these guys, which companies these guys are working with for or own. And overall irrelevant because I don't think they don't have enough details on their multifamily experience, which is what I would really want to know.
Awesome. Mike, anything you want to add to these slides? Just show about the group.
The biggest thing with like that first slide, just the relevant data that they give is not really telling you that much about what they're going to do here. The guy on the left, Scott, it's like he's managed construction projects and that kind of thing. So if they're doing a heavy value add, that's going to come in handy, but it doesn't really tell you too much that way. And this where he turned the 150,000 into 6 million in equity in 5 years. Is that in multifamily? Is he doing flips? What's it from? And then the guy on the right, senior management team worked across that. It's like, we don't know what his role was in those 4,400 multifamily units, how involved he was. He's talking about underwriting deals. There's a couple times in here where people are talking about how much time or dollar amounts of underwriting a deal. Well, I invested in $1 billion deal and I underwrote it. So therefore I've done billions of dollars, and that doesn't mean I'm good at it, All
right, let's move on here to the sort of, so there's more details about their bios. You touched upon this, and then there's this fund governance. Mike, anything you want to say about this slide?
No, I mean, it just, so they hired some people to be a CPA and legal. It doesn't really help that much. It doesn't tell me anything.
Yeah, and just like point out, like we're talking about fund, and then in a second we're gonna talk about a deal, right? And there's anything, right?
Yeah, they go back and forth with that language. I'm not sure if they just pulled this from a fund, and then that's why there's a lot of fund information in there. They're kind of like copying somebody else's deck, or if they're really thinking they're going to create a fund and they're just telling us about the first deal. But this comes across as though it's confused. It seems like it's a single asset deal that they want you to invest in, but they talk about a fund all the way through.
All right. Well, up until here, it's basically, it sounds like it's a fund, right? Everything's in fund, right? Hans, anything you want to add on the opportunity here?
I agree. I think it just shows a lack of sophistication, quite honestly. They're not using the correct language. This is, in the end, this is a single asset deal. When we finish the deck, and they keep referencing a fund model or et cetera, et cetera. And so it doesn't, like this targeting assets that are currently underperforming appreciation for the portfolio there on the left side. There is no portfolio. This is a single asset deal. So the problem with it is that the terminology just isn't being used correctly, and it shows either they did it too fast and didn't review their terminology, or they're unsophisticated. And either way, it gives me a little bit of heartburn.
Right. So yeah. So basically, we're talking about a fund here. Right? Up until now, they're talking about a fund, a pool of money that they will deploy based on this strategy. That's what they're talking about. But then when we dive in for a second, we'll see some other stuff. Right. That's the idea. All right. Now, and here's like where it changes. Right. The terminology just changes for a second. Now we're talking about the property. Right. Hans, you want to kick this off?
Sure. Didn't really have a lot to say about that particular slide. I will say that in general, one thing I did like is that the seller is the original developer of this property, which always usually means there's probably is opportunity. I've done deals like that because, when somebody owns a deal that long, they typically don't squeeze every ounce of value add out of it. So typically these kind of deals do have some good value add. I did like that part. And then my only other comment, I guess, here is that they mentioned raising rents by $148 a door is great, but they don't provide any comp sets, anything showing submarket rents, anything like that. They just state that they're going to projecting a minimum of $148 in rental increase per door. So there's nothing to support it. So that's pretty much my comments around these 2 or 3 slides.
Mike, anything to add?
No, similar. The other thing is like when you get down a few slides, they are showing 795 in the first year, which is actually $153. But yet in that slide before, they're talking about it over the term of holding it, which could be 2 to 3 years. So there's just a lot of sort of ambiguity in what the plan is, and agree with Hans. They're telling me what these things are, but they're not giving me any supporting documentation so I can assess whether 700 to 900 is reasonable.
All right, let's continue here to the Midwest multifamily investment, which is what they're talking about, the projected returns to investors. Anything we want to talk about here, Hans?
Well, they mentioned temporary price dislocation. What does that mean? That doesn't mean anything to me. That's just, it's kind of just a boilerplate term with no real comments around it, no context at all. And the 16 to 25% AAR is way too wide a range for projection for a single asset deal. It really is too wide even for a fund. And they're using average annual return. They should be using IRR, which is internal rate of return, which gives you a return based on the time value of money. So it's just another data point that shows lack of sophistication, in my opinion.
Right.
And know what their actual plan is, and agree with the temporary price dislocation. I'm assuming they mean that cap rates have gone up with the interest rates rising, and that they're talking about that, but they're not telling us what that is. If it's something where there's a divorce, somebody just died, a state is fighting or something like that, then give us a little blurb as to what that is to let us know about it. Otherwise, it's just a throwaway term.
I'd be curious to know how they reach this AAR. Even if
they're coming up with a 1.5, and it's just, does it take us 2 years or 3 years? We're going to return the exactly 50% return. It just tells me it's paid up. They don't really know what they're doing.
But even if it takes 5 years, then it's 30% AAR, right? Like 1.5 divided by 5 is it's 150%.
No, they're saying
the longer it goes, the lower it goes.
You're going to get 150 back. And so if it takes them 5 years, that's going to be a 10 AAR, right, and an even worse IRR.
Yeah. So it's weird how they got the numbers. Okay.
That's why I don't use AAR. It's just a sophistication issue here.
All right.
Well, sophistication, or they're returning all the money late and you're not really getting anything up front, and they want to make it look better. And so then they're going for the investor that doesn't really fully understand IRR versus AAR, and they're trying to manipulate it to make it sound better, is another option.
Yeah. All right. Let's assume they're not doing it to make it sound better. They just might have made a mistake. All right. Let's dive down here to skim through the pictures. Anything to say about the major amenities that it's near? Mean anything?
For me, I mean, the thing on the left, so they clearly show where their property is. it's sort of right on that edge of the commercial, which is good if it's commercial that people are wanting to get to. But all you've got is a Goodyear Tire and a couple of self-storage type places. It's not something that looks that desirable. And then on the right, I'm assuming that in that bottom right-hand corner, that is the property, but they should really spell that out so I know that's what it is, and then know distances to these things, because that's great if it's pretty close to the Southern Park Mall. But I'm not positive, where this is. That just another detail they should throw in the slide.
Right. Okay. So into the pro forma. Hans, you want to take this?
Yeah. So I have quite a bit to say here. And I think that quite honestly, for your listeners, this is the most important slide in the deck in terms of maybe listening to our comments, in my opinion. It's great, number one, that they provided a pro forma. I've seen decks where they don't provide anything like this. So it's great that there is actually a pro forma P&L, but it really needs to go beyond NOI. NOI doesn't mean anything to me if you don't also include debt payments, include below the line asset management fees and other below the line fees, and basically an ending number of cash flow that would go to and that would be split between the sponsors and investors. Note that for year one, they're showing an average of 153 per door increase in rents. That, if you notice, is more than their projected 148 a door that we saw in an earlier slide. So that's a first red flag to me. I mean, that just can't happen, right? Their year one projected rent increase is approximately 24%. It's way too aggressive, considering that they have to turn units and do upgrades to do this. You can't, in an apartment, you can't just turn a knob and the rents go up. You have to move people in and out. An average turnover in an apartment complex could be anywhere from 40 to 60%, depending on the market. So it has to be blended in. You can't just raise rents 24% in year one. And they basically kept expenses the same from the current. Probably also way too aggressive. And they provide no support for this. And I think the biggest comment I have here is if you look at their year one NOI over year zero for your listeners means current. That's the current model. That's how the property is being operated. The year one NOI is a 60.5 increase in year one from present, meaning they increased the net operating income of the property by over 60% is what they're projecting. I'm sorry, that's crazy. That just doesn't happen, basically, and especially from less experienced operators. So it's a huge red flag to me.
What do they mean by the other income, do you think?
Other income, it's honestly, after all the comments I just said, is kind of irrelevant and de minimis for this discussion, but other income can be anything from, valet trash fees to pet fees to late fees to all those other types of
on-site laundry facilities that aren't in units.
Yeah.
Mike, do you want to add anything to this slide?
No, I just really reiterate what Hans said with the average rents in that year one. That tells me without some sort of a better plan and stuff, it's just like that tells me right away they don't know what they're doing as far as like how to present this, how long it's going to take, which just goes back to what we saw earlier. There's nothing in this deck that's telling us that these are experienced multifamily operators that have done this multiple times and can take care of this and have a good plan to put together. If you had, something realistic and you were getting to the 795 by year three and it was paying attention, that'd be fine. The other comment I would make is that in the other previous slide where they said 148 and then this is 153, that was on 1 bedrooms and there's only 1 2-bedroom. So it could be that this would be higher if they had a lot of 2 bedrooms or something like that, but they have more studios than they do 2 bedrooms. So there's just mathematically, I don't even see how they get there. The other thing is like taxes, for example, depending on the state, they could go up substantially. If this thing has been held by the original family since 76, you could be vastly under market on what it's really worth versus what the sale price is as far as the tax rules. And so I need to see that. I need to know that makes sense. And if it's something where that's they can give me that story, then I feel comfortable with it. But otherwise, it just seems like they threw this into an Excel sheet and just took what the year zero was and then just started adding a percentage. And haven't really put together a well thought out plan. Same with things like insurance and payroll. We've seen a lot of insurance in multifamily go up 30 to 50%. So you know, again, tell me about that. You know, was year -1, you know, a fraction of that, and then this is why they think it's going to stay the same in it. Payroll, maybe that needs to go up or down. They're talking about it being not really taken care of as well. Well, it depends how you're going to achieve those results as far as what the payroll needs. So
All right.
it sort of seems like I agree with Hans. I love that this slide isn't here. I want all decks to have this kind of thing, but with this numbers, you've got to explain more to me of how you're getting it, or else I don't believe it.
All right. Let's move on here to these performers. Mike, anything you want to say on this slide?
No, I mean, it's another project that they had that, you know, looks like they did, you know, some basic yard work with that, you know, didn't cost a lot, but makes it look better. So, but I didn't see a whole lot there.
I did have one comment on this slide. It's obviously a successful project, you know, raised rents by 224, so that's great. You know, not, you know, it sounds like they've been really good. The main comment I have here is it says identical cardinal style multifamily. Now, this is a nuanced comment that most people won't know, but I thought I'd at least provide the value here. Cardinal means it's Cardinal is a company that I think now is in bankruptcy, but they produced modular housing back in the 80s and early 90s, I think. And so there were a lot of multifamily properties that are built by Cardinal, and they're modular. And so they've kind of got a reputation for being built like not as well, and to have more deferred maintenance. So it's good that these guys actually have experience with a Cardinal property. Since London Square, this current deal is also a Cardinal property, but it's only their second one, it appears, and they're very inexperienced. And so it still makes me nervous, but I am happy to see that their prior deal is the same type of project, because if this was these guys doing their first Cardinal deal, which is a very nuanced, you know, type of building, and people aren't expecting the deferred maintenance with these kind of deals, then I'd be even more worried. So I just wanted to point that out for if you ever see deals with Cardinal multifamily.
Right. That's important. Okay. Yeah, now it's comparing basically between their current deal and that case study of what they previously did. Anything you guys want to say on this, Hans?
I didn't have much to say about this slide. I didn't think it was that relevant because we've already looked at you know, other differences. It's good that they compared their deals, but they look to be very different, quite a bit different deals.
What's the big difference between the deals, basically?
Well, one of them's very light value add, and the other one was very heavy value add. It looks like they're just trying to force rents here at London Square, like I mentioned before, without any validation. So, you know, in all honesty, I did not spend much time on this slide because I found other slides much more relevant than this comparison. Let's
go down then. Track record. Anything you want to say on this, Hans?
Well, I think if you really what I want to talk about is slide 26. I mean, this is just kind of a summary, but slide 26 is the detail of that slide.
I'll give a couple comments on slide 25. So this is the first slide that this shows up, but they've got the asterisk down below: managed, controlled, or owned by Bloom Wealth Partners principals. So what we don't know is this 30 million, do they manage it, do they control it, or do they own it? Same with the units. And then the full cycle deals, there's really no calling out as to what these are. Is this something, I mean, that could be somebody doing fix and flips, or it could be very relevant multifamily. And it just, you know, I don't think that they're giving us enough information to know how relevant this stuff is. And the disclaimer makes me think that it's not that relevant.
Okay. All right, let's go down here to the data. Track record.
Yeah, so my first question and my first comment is, if you notice the second to last column says projected value. So all are projections, but in the previous slide, they had full cycle deals. So where is it? Why aren't these actual sales prices and not projected values? Because they stated literally in the previous slide, they had 5 full cycle deals. And then let's say they are all projected values. Well, then how were those calculated? Who calculated those? They calculated, they have independent third-party appraisals, et cetera. If you look at the equity multiples, mathematically, especially the last two, just pretty much don't work if you just do the math and assume a normal investment and a normal loan to value. There must be either a calculation problem or a misunderstanding by the sponsors on how to calculate an equity multiple. That, quite honestly, is an extremely big red flag to me. The 3 at the bottom are sold. because they said this in future slides, if you go where they do case studies, those are actually sold deals, but then it says projected value. And when you're looking at these kind of track records, it's good to have this info in there, but you've got to be more specific, and you've got to provide what was the original equity invested in these deals. Telling me the purchase price and the projected value and then an equity multiple doesn't tell me much. I need to know what was the original equity invested, what was the actual sales price, how much did you increase NOI, and then what was the IRR and what was the true equity multiple. So it's to be honest, this slide raised more red. It's great that they have it. I always want to see a track record, so I will say that, but it honestly raised more red flags for me than it gave me confidence.
Other things with it, the hold periods and stuff, even the 3 that they did sell, they don't really give us the timing of things. Like the last one, the Aurora Apartments, the only way that isn't a math error is if it's something where they did owner financing and put like $10,000 or $20,000 down and had the rest owner carry or something like that. Otherwise, you just cannot come up with that kind of multiple. Or they're talking about just their own equity and not somebody else's. There was, some debt in there or something else that you don't know. The other thing, asset class. So they've got 2 hotels. We don't know really, are these hotel to multifamily conversions, or are they staying as hotels? It sounds to me like they're staying as hotels. Then they've got a retail, and then we've got the one multifamily that they're talking about. So this is another thing that tells me these guys are all over the board in what they're doing. So in the beginning, it's telling us about this fund and what they're planning to do. But yet when they're telling us what their track record is, they've got all these different asset classes that take a lot of different skills to sort of come to fruition on. And it helps me to understand even more that they aren't probably that experienced in this multifamily type process that they're looking at.
All right, let's move on here. So these basically are just like replicates of this table, right? Just laid out a little differently. Do you guys want to say anything about case studies? Like, what would you want to see here, Hans?
I mean, let's just take this one for example. What I'd want to see here is, what was the original pro forma? How did you increase value? What was the actual value? You should be able to list out your value add plan in 2 or 3 sentences and say, okay, this is how we force value in the property. We raised rents to market, and then we did upgrades for X amount of units, and those upgrades then were able to be raised. So that's how we increased NOI. All they're saying is just the purchase price and the sales price. That doesn't tell me really. I mean, they might have had cap rate compression there, and they didn't do much except just hold the property, which is how a lot of people made money over the last few years. So I want to be able to look at a slide on a case study and in 2 or 3 minutes understand the general business plan and how they created the value. That's what I'd want to see.
Mike, would you add anything else to that?
No, agree. And looking at the past original pro forma versus what the results were and how they did it, that's another key piece of this. So we don't know the hold time period. Was this 13 months or was this 15 years that they had it? And really, what were the projections and did they follow that? That's where the case studies really start to help, is where you see past decks, this is what we put out there, and then this is how we returned it, and this is why we did it, how we did it, and what went to plan. And they're not giving us enough information to know if this is relevant.
Right. Well, specifically that Revel Apartments is here like in the line before last. Right?
Yeah, 4-year hold.
Yeah. So they are doing that again, like the 9X. I don't know how do they reach that, but yeah. All right. Key terms of this specific offering. Mike, you want to start with this slide?
Yeah, so this, again, up till now, we've kind of gone back and forth as to not being sure, were they talking about a fund or a specific deal? We initially thought fund, then it looked like it was definitely a specific deal. This sort of helps seal it that it is definitely a single deal where they're saying we need 2.9 because that's the purchase price of this. Now, we don't know, though, is that the purchase price of it and what's the debt? There's no real, or is that the equity that they're raising? What's the purchase price? If there is debt, I want to know exactly, what rate they're at, how long they're locking in, are they locking in, that kind of thing. The next is it just doesn't make any sense to me with this target and the multiple. It's just to me, it feels like they randomly chose a number that they're going to go up 50% in value. And then they're not sure if it's going to take them 2 years or 3 years, but it's going to be 50% of value. But yet when you go down to the fund life, which again, they're using the word fund, it's a 5-year offering, but they're targeting 2 to 3 years. These guys are just all over the board on this, and it doesn't really tell me what's going on. Then you've got an 8% preferred return, but there's nothing in here about fees that they're collecting, splits, anything else like that. They don't tell you they're going to definitely get you that 50% multiple. That's just their target. The only thing we know for sure is they're saying you will get that 8% preferred return. There's just so much missing information here.
And they're back to calling this a fund, right?
Yeah.
Yeah, Ohio focused, that kind of thing. It's like, no, this is a specific deal. Just tell us where it is. It's not, unless this is a fund, and then you've got other things that are completely wrong with the deck.
I agree with what Mike said. You got to have fees in here. You got to have the waterfall structure, the comp structure. That's not provided. The whole thing about a target 2 to 3 year investment period makes 0 sense when you're buying a single asset deal. That's a fund. That's pure fund language right there. So they copied that from somewhere. And really the biggest, they're all big, but the biggest issue I see here is, how do you make a 1.5 equity multiple, no matter whether you hold it 2 years or 3 years? That is impossible. You can't have the exact same equity multiple if sold in year 2 versus sold in year 3. It makes 0 sense. So that tells me they don't know how to, honestly, don't know how to calculate returns. And it's again, a really large red flag. I don't really, I have a million things to say about this slide, but those are the biggest ones right now.
All right. And then these are sort of examples, right?
This is their 2 and 3 year example that I just mentioned, which makes no sense. You don't make the same multiple and the same absolute return for the investor, whether you sell in year 2 or sell in year 3, unless you're just saying, we're going to pay you only 1.5 and take 100% above a 1.5 multiple, which it just doesn't make sense.
It could be. That's the thing. We don't know. They're not talking about waterfall splits, anything like that. We don't know fees. There's just so much information basic information that you have to know and understand before you would invest that is not included in this deck.
Yeah. So this is basically the end of the deck.
Well, no, this is crazy math here. Go back to that one. So this is saying if you invested with them and then just kept rolling things over every 3 years, then they're just sort of like giving you this crazy thing of like, oh, you just give us 100,000 and then just keep with us and we'll just keep going. And we're going to have the exact same deals every 3 years. There's not going to be any loss of time where it's sitting unused. We're not going to have any deals that are above or below this. And guess what? Magically, we spit out 506,000 at the end of the 12 years if you just trust us and give us 100,000 and keep reinvesting.
Yeah. And I think this is, again, a fund model, right? Like this is what funds just have the reinvested returns go back into the fund.
Conceptually, but it's just such a jumbled mess.
Yeah, this type of slide, like the place where I rarely see this type of slide, but the only place where it's relevant is if you do have something like an evergreen fund that they have a long track record that they've been going for 10 years or something like that. They know what the returns are. And then they can show you what the projected returns are. You can compare that to the actual returns over the last period of time. And as long as they're giving you something fairly conservative like that, especially if the actual results are at or significantly higher than what the projections are, this can kind of just give you this idea of like, hey, you're coming in with us. We do a great job. You can kind of put your money away and trust us. But with this deck, this seems completely out of place and just doesn't make any sense to even have it.
Would it be fair if I sum this up in a way that says this deck needs a ton of work? It's hard to understand if this deal makes sense or not. It might make sense, it might not make sense, but it's extremely hard to understand that from this deck. The risk, the returns, like it's just extremely hard to understand. Would that be a fair summary of this deck, or would you guys even go further?
Well, another thing that I would say that they completely missed on this is one of the most important parts of having a deal, especially if you start getting into 2 to, more than 2, but say like 3 to 5 years, that type of thing, is who's running it. None of the people that we saw in their bios have any experience that I'm seeing directly operating and managing this type of unit. So are they doing it themselves? Are they going to have somebody else do it? How's that going to be done? Because that's a key piece of information if this is going to be a successful project in the end.
Right.
That's completely ignored.
Yeah. Hans? Be nice.
Yeah, this could be a good deal, but it's not a good deal because the sponsors aren't ready to be running a deal like this, in my opinion. It very well may be a good deal. It looks like there could be some value add, but it's really impossible to tell based on the jumbled way this is presented and in the lack of sophistication provided. It's you know, it like Mike said, there's so many open questions I have. I wouldn't even know what to, whether to invest or not at this point.
The two things that I like the best out of this whole thing is that they're saying that this is somebody built it in 76 and that the original owner or family has run it the whole time.
Agreed.
So
that's a great model.
That can be an amazing opportunity. There's a risk with it. You have to make sure because there's a lot of things have changed since 76. So you're going to have to be really careful that they've done some of the key infrastructure things that could be extremely expensive. So it's very important that they know exactly what the condition of those things are and they're explaining that to me and that their pro forma makes sense for that. But that type of deal can be a great asset where there's a huge amount of upside. But that's what I like the best about the deck is the potential with this deal. But there's so many things that it just doesn't give me the vibe that these guys, that their deck isn't presented in such a way that makes me feel confident in them. Presenting it to me, I don't have nearly the information I need. And then that makes me think that they're not ready to, have my money and really perform on their plan.
Yeah. You want to be able to read a deck. And there's a good analogy I heard one of my buddies say one time. I want to feel like I'm getting a big, warm bear hug from the sponsor, and I feel all safe and fuzzy before I give them my money. And that's the way the deck should feel. And I don't feel warm and fuzzy right now.
I can't imagine you feeling warm and fuzzy, Hans, but all right, we'll take that.
I do.
I will say one thing that it's important to emphasize regardless of this specific deck, but it is important to say, I think, we're talking about the experience of the operators, the fund managers or whoever they are, the key executives in this deal. And I think more experienced operators wouldn't really look at small deals like this because it's a relatively small deal, right? There might be meat on the bone, but I don't know. What do you think of that?
I will have to push back a little bit on that because I invest with a guy that is buying like a 70 unit property, and he's very experienced. And the guy is like, I love his decks. He does an amazing job. So it depends on what your model is. You can go buy 2 or 3 small 70 unit deals and aggregate them into a portfolio in a certain market or things like that. If the deal makes sense and you have the critical mass and infrastructure within the market to operate it, I don't think there's anything wrong with buying a smaller deal per se. In general, you're right. As you get more experience, you buy bigger deals. But it's not always the be all, it's not always the case. And I will say one thing. It's okay to invest with new sponsors and people that are inexperienced, but they've got to be able to present a business plan and a deck that comes across as that they've really thought through the strategy and they really understand what they're doing. So I've invested with new investors in the past, but they also presented decks and had a very strong business plan and answered my questions very well. Now, these guys don't have a chance to answer our questions, so obviously, but the deck itself really needs some improvement. Even though the fact that they are inexperienced means their decks really got pop, and they really need to show that they have thought through the strategy. It's all about the value add in any of these deals. It's about whether the sponsors provide clarity to the LPs, whether there's a true value add to the deal. That's what creates your margin of safety.
Yeah, I agree 100%. All right. Awesome, guys. Well, this was good. I mean, obviously the deck could have been better, but I mean, we hope that people learn from this and we'll continue to learn with the decks we do in the future. Hopefully we'll have some better decks to review. Appreciate you all. Have a great day and we'll see you soon.